Good morning all, and thank you for joining this morning's session. So in this one, we'll be going over leases and impairments. And as you know, we'll record this so that you can watch it back through Rogo after we've uploaded it. And any questions that you've got, just make sure that you pop them in the Q&A, and I'll pick those up after. But as you know, if you can't think of any right now, just email me after. That's absolutely fine. So let's switch over and make a start. Right then, so task one, identify which of the following are current or non-current assets. So a nice, easy one to get us warmed up and into the mood for this one. So we've got trade receivables. So we've got current assets, remember, are those that we'd use or expect to be used within 12 months. And the non-current asset are those that we'd expect to last and be used for longer than 12 months by the business. So trade receivables would be current. So trade receivables, remember the amounts that are owed from customers. Prepayments, again, current. So where we as a business have paid for an expense upfront that relates to the following period, or a following period. Land would definitely be a non-current asset. Definitely expect that to last for more than 12 months or be in ownership for 12 months by the business. Vehicles, again, non-current. Cash and cash equivalents would be current. Inventories, again, would be current, to be using those within 12 months. Plant and machinery, definitely non-current. And office equipment, again, could include a range of things, but would be a non-current asset. A nice one to start you off there. So B, identify which of the following are characteristics of a non-current asset. So must be tangible. Well, we can have intangible assets as well. So that would definitely not be true. Can be tangible and intangible, certainly can. So if you think about intangible assets, so intangibles, we've got stuff like goodwill, trademarks, and even such as certain software. They are expected to be used over more than one period of 12 months, or we know for a non-current asset that is absolutely true. It's expected to be used within 1 month. One period of 12 months, definitely not. C then, identify which international accounting standard deals with tangible assets, so property, plant and equipment. But if you did level 2, if you did level 3, you may actually be familiar with this one already. It would be IAS 16. I think for 2 is inventory. 16, property, plant and equipment. What else have we got? So we've got 36, which covers impairments. And 37 is provisions, isn't it? Provisions. You've got, of course, contingent liabilities as well. So that would be IAS 16. Moving on to task 2 then. Identify which of the following IAS 16, which of the following IAS 16 considers when dealing with non-current assets. So impairment of assets, Absolutely not. I think we've in fact just said that is covered under IAS 36. When to recognise an asset, it definitely covers that. How to record the carrying value of an asset, definitely records that. How to record leased assets, absolutely not. We'll actually be touching on these later on. That is covered under IFRS 16 now. When and how to depreciate non-current assets, certainly would. And intangible assets, absolutely not. Covered under IAS 38. B then, which two criteria must be met when identifying whether an asset should be recognised in the financial statements? So we have two sort of parts to this, and you may have seen it, or hope you've seen it, within your textbook at some point, where we get the definition of when to recognise an asset. So, two key points: probable future economic benefits. See that term quite a lot. Economic benefit will flow to the entity. Okay, so that could be that it generates money. It could be that the asset saves time and therefore money, but it will create some form of economic benefit to the business. The second one is that the cost of the asset must be reliably measured, i.e., you need to have some way of knowing that the actual value of that asset, and that is a method that is accepted under IAS 16. And we will actually be talking a little bit more about those throughout this. C then, companies are permitted to value their assets on two bases. Identify which model the following descriptions relate to. Where non-current assets are revalued, so keyword there really, revalued periodically and revalued at their fair value less any subsequent accumulated depreciation, i.e., they are looked at, they are revalued, and then you would, from that point onwards, continue to depreciate them. So that would be what we call the revaluation model. Okay, and remember that if you go with the revaluation model, you have to apply that to that entire class of assets. So, for example, if it was buildings and you picked to use the revaluation model, you would have to choose the revaluation model for all buildings. You couldn't just pick to do it on one and then use, I'm not going to say it because it's going to give away the next one, but use the other valuation method for certain buildings. You can't pick and choose. It would apply to the entire class of assets. The next one then, where non-current assets are valued at their historic cost less accumulated depreciation. So the classic method this that you've probably seen throughout your studies so far, and that is the cost model. Okay, so literally just valued at the original cost less accumulated depreciation. Moving on to part D then, identify which of the following statements are false. If an entity chooses to adopt the revaluation model, then may have covered this a second ago. then all assets in the same class must be valued using this basis. Well, that is true. Okay, and this one wants you to identify which of them are false, so it wouldn't be that one. If an entity chooses to adopt the revaluation model, then only that particular asset must be valued using this basis. Well, that is certainly false. So as I've just mentioned, it would be the entire class of assets that the model applies to, not just one singular asset. Let's just check the other ones. So under the revaluation model, assets of that class must be revalued regularly to ensure the carrying amount of the asset doesn't materially, doesn't materially differ from its fair value stated in the financial statements. Well, that is absolutely true. Revaluations, the business would pick how often they wanted to do those. It can be done yearly, it can be done every 2 years, as long as they are fairly regularly, that is, and it's done across, as I said, the full class, that's absolutely fine. That information would actually be included when you produce your accounts as well. If an entity chooses to adopt the revaluation model for a class of assets, then other classes of assets can continue to use the cost model. They absolutely can, that is true. So it only applies to each class of assets. But you could, for example, do land and buildings using the revaluation method, but you might do motor vehicles using the cost model, which is absolutely fine. Moving on to task 3 then. Where an asset is revalued upwards, what are the accounting records to, or what are the accounting treatment to record this? So what we would do is we would debit the value of the asset. And we would credit the revaluation reserve. Okay, so when an asset goes up in value, to record it, as I said, we would increase the value of the asset by the difference effectively between what it's worth and what it's valued at in our accounts, and we would increase the revaluation for the same amount. B then, where will this appear in the financial statements? So it would certainly increase the value on our non-current assets. It would go in our other comprehensive income when completing our statement of profit or loss and other comprehensive income. So it would go in that, if you remember from chapter 2, it would go in that very bottom section on our statement of profit or loss and other comprehensive income to show the increase in the value of the asset. It does not go as additional income because it goes under other comprehensive income, so that wouldn't be. Equity section, but it certainly would go to our equity section. So our equity section, if you remember, is made up of usually 3 elements: share capital, retained earnings, and the all-important for this one, revaluation reserve. Okay, so I'm going to ask my own question and then answer it here. Why does the revaluation not go as earnings? And the reason for that is because we haven't actually sold that asset yet. So if you imagine it's land that we've revalued and it's gone up in value, because we haven't actually sold that land, we cannot class it as what they determine as realised income. Okay, because until we have sold that non-current asset, we haven't actually made that money on it, have we? So that's why we have the separate account for it known as your revaluation reserve. If you were to sell it, then that would then become realised, that additional income, and would eventually go to your retained earnings. Part C then, which of the following costs could be included in the cost of a new industrial drilling machine? So they state that anything that bring the asset to a usable condition can be included. Okay, so we could have the cost of site preparation. We could have the cost of testing the asset before being brought into use. If it was an ongoing cost after, so after the asset was brought into use and it was an ongoing cost, as in maintenance, then we wouldn't be able to have it. C, cost of professional fees. Okay, well, if it was a case of legal fees, which I believe this is actually referring to, so we've got architect or surveyor, i.e. for legal, such as legal purposes, okay, to be able to actually use the asset. So it may be that a surveyor has to sign off on it before that you can actually use the area in which you've placed that asset. They can be included within the cost of the asset. Cost of, and this is the key here, ongoing maintenance, okay, it cannot be included into the cost of the asset. It's classed as revenue expenditure. It would go to your statement of profit or loss. Cost of initial delivery certainly can be. If you don't get it delivered, if you don't bring it to the site where it's going to be used, then you can't use it, and therefore you can certainly include that. Cost of, and keyword here, replacement. Okay, if it is a replacement drill piece, you would not be able to include it. Part D then. The company purchased a new machine on the 1st of January for use in the production process at a cost of 200,000. The machine has an estimated useful life of 5 years and a residual value of £10,000. Calculate the depreciation expense recognised in the statement of profit or loss and the carrying amount of the asset to be recorded in the statement of financial position as at the 31st of December 2000 and go with 13, it doesn't matter really, but these dates I can tell you now are going to be absolutely key to working this out. So we first need to do it on the straight line method. So straight line method takes into account the residual value. So we need to do the cost, 200,000, minus the residual value of 10,000, divided by 5 years, because that's how long the estimated useful life is. And therefore the depreciation is £38,000 per year. So this is the straight line method. So the depreciation amount will remain the same year on year. So in here, we can just put 38,000, 38,000, 38,000. And then the carrying amount is going to be the cost less depreciation. So we would have effectively 200,000, so the cost less 38,000 equals 162,000. And the next year, 162 minus 38 is 124,000. And then year 3, 24 minus 38 equals 86,000. So nice and straightforward, nothing hopefully too complicated there. We'll now do the same, but with the diminishing or reducing balance method, which does not take into account residual value. So what we would do is 200,000. And remember, this is calculated on the net book value each year. So 200,000 times 20%. The depreciation for that year would be 40,000. And the carrying amount would therefore be 200 less 40 equals 160. Now remember, under the diminishing balance, we would expect the depreciation to be higher at the start, and then it will gradually lower over time. So the next year, as I said, it's worked out on the carrying amount or net book value, same thing. 20% equals 32,000. 160 less 32 equals 128. And then year 3, 128. You can see here depreciation getting lower each time. So this would suit certain assets more than others. If you think about such as a vehicle, they tend to lose more value at the start and less as time goes on, whereas some tend to be a bit more linear. Okay. So hopefully no major issues there, and we can move on to task 4. So we've got here, choose from, or well, complete the following sentence, choose from, and then we've got a few options there. A business does not necessarily have to, and then it's something, an item for it to be considered an asset. So a business does not necessarily have to, and out of those options, that would be own. Own an item for it to be considered an asset. It may be enough that it's simply, and that would be, controls the item, i.e. you have use of that particular asset. A lease contract is an agreement between the lessor, who owns the asset, and the lessee, who leases the asset. The lessee has and it would be the right of use. The asset in exchange for payment made to the lessor. So what they're saying there is effectively you don't have to outright own that asset. If you are paying for the use of that asset and you have the right to use that asset, then it should be recorded as an asset in your accounts. So B, is the following statement true or false? A contract is or contains a lease if it conveys the right to control the use of an identified asset for the period of time in exchange for consideration, i.e., do they have the right to control and use the asset in exchange, usually, not always, but in exchange for payment, usually, in money, but consideration has to have it usually has a monetary or has to have a monetary element to it. So that would definitely be true. Complete the following sentence. A lease liability will be recognised at the, we've got some options here, present value of the minimum lease payment, i.e. what will be owed at that time of recording, less discount factor, but we'll come on to that very shortly. This liability will then decrease over the lease period as we effectively pay that off over the lease period until it has been completely repaid by the end of the agreement. Right then, moving on to task 5. Axel Limited is a parts manufacturer. In Axel Limited's latest financial year, it entered a number of lease agreements for assets as below. For each, you should identify whether it should be treated as a short-term lease, low-value lease, or just a standard lease. So, short-term, let's just think about these. Short-term lease, 12 months or less. Low value lease, a little bit more of a grey area. It's not as determined as short term. However, what they would look at, or what you need to look at as a business to determine whether it's a low value lease, is what is the item? Is it for smaller items such as laptops, in which case you could usually class it as a low value lease? The sort of number that is thrown around that is generally accepted is around 5,000 or less over the period of the lease. But I think a lot of it comes down to what the items are. So is it some sort of, like say, laptop, office equipment with a lower value? So smaller items, such as office equipment, and I would say expected under 5,000. And then a lease is just the standard lease, so it doesn't fit in with the other two. So leased a packaging machine on a 10-month lease. The value of the machine is £7,000. So under 12 months, it can be classed as a short-term lease. Leased a van for making small deliveries on a 3-year lease. The list price of the van at the time is £16,000, and the lease payments are agreed at £460 per month for the duration of the lease. Would fall under a standard lease. Definitely wouldn't fall under the other two. Leased a machine on a 4-year contract. At the end of the 4-year period, they will own the asset. Now, if they own it, okay, and it doesn't fall under these two, it would be classed as a normal lease. And then the last one, lease a photocopier or printer. The term of the lease is 2 years and the value of the printer is £1,500. that will be classed as a low value asset lease. Right, moving down to task 6. Right then, so it says here, Mason Engineering Limited have leased a machine with a lease term of 4 years. The commencement date is the 1st of January 2013. The asset has a useful life of 10 years and lease payments of £10,000 per year, with the first payment being due on the 1st of January. So the first payment is due up front. The present value has already been calculated as 37,230. Mason Engineering will own the asset at the end of the lease term. The interest rate implicit on the lease is 5%. What entries will be entered into the statement of profit or loss at the end of the year? Right then, so we're going to have 2 here. Into the profit or loss is absolutely key, because the 2 entries that will always be entered into the profit or loss will be the depreciation charge and the finance cost, i.e. the interest on the lease. So what we need to do is first work out that depreciation charge. So it already says that the present value, which is what it needs to be valued at, has been calculated as 37,230. And it says the useful life is 10 years, and we will own the asset. So what we need to do is 37,230 divided by 10 years. And that would give us a yearly depreciation amount to go to the P&L, 3723. The finance cost, to calculate that, this is where I said this will come in use, important later down the line, is that the first payment is actually due at the beginning of the year. So what we need to do is we need to do the present value minus 10,000, because we paid that. We don't want to be charged interest on what we've already paid. And then multiplied by 5%, because that is your interest rate. And that comes to 1,362. It then says, identify the entries to be entered into the statement of financial position at the year end. Okay, so within your property, plant and equipment, the net book value is going to be 37,230, which is what we originally recorded it at, or would have originally recorded it at, minus depreciation. So this would now be valued at 33,507. The lease liability would be calculated as our original value, so our present value, minus the 10,000 that had been paid, plus the interest. So that would come to 28,592. How will the lease liability be split between the non-current liabilities and current liabilities in the statement of financial position? So remember that non-current liabilities are expected to be paid beyond 12 months, whereas current liabilities are expected to be paid within 12 months. That would be 10,000, as the lease payment is £10,000 yearly. And then the remaining amount, so we're basically taking this here, splitting it. So it would be 28,592 less 10,000, which will be paid within the next 12 months, leaving you with 18,592. Fantastic. Right, okay. So task 7 then, identify which international accounting standard deals with the impairment of assets. So I spoke about all of these earlier on. So that would be IAS 36. It then says one of the machines owned by the company has been damaged and might have become impaired. Details of the value of the machine are as follows. So we have the carrying amount, fair value, cost of disposal, and value in use. Okay, now, what we have to do, or what IAS 36 states, is that if an asset is to be impaired, i.e. if you've got the fair value less cost to sell and value in use are both lower than the carrying amount, then you need to impair the asset. So what we need to do is, firstly, we do the fair value minus cost of disposal. And we've also got the value in use of 43,200. And then the current carrying amount is 54,000. Okay, now, what you would therefore do is we can see straight away that there will be an impairment because the fair value, less cost to sell, and the value in use are lower than the carrying amount. Now, what the IAS 36 states that we can do is that we can value it out of the higher of these two figures. Okay, now this one will be 4,800. And the value in use is simply 43,200. So we know it's going to be impaired, and it says that we can value it at the higher of these two figures. So it states what amount should be recognised for the machine in the statement of financial position. Well, the higher out of those two is 43,200. So it would be valued at the value in use. It then says, what is the amount of impairment loss that will be recognised in the statement of profit or loss? Well, if the current valuation in our accounts is 54,000, and it's going down to 43,200, the difference between the two will be our impairment loss, which comes to 10,800. The impairment loss that would be recorded in the statement of profit or loss would be 10,800. Okay, moving on to Part C. The company owns 3 assets. Due to a fire at the factory, there is concern that some of these assets may have become impaired. The following information is available. So we've got carrying amount, fair value less cost to sell, and value in use. So what we're saying is if these two are both lower than the carrying amount, then there is an impairment, and we need to value it at the higher out of these two. So let's have a look at asset 1. Carrying amount is 25,000. The fair value less cost to sell is 26,000, and the value in use is 22,500. Well, are they, i.e., is the fair value less cost to sell and the value in use lower than the carrying amount? No, because this is 26,000, so this is higher. So therefore, there would be no impairment. Asset 2, the carrying amount is 37,500. The value less cost to sell is 34,000. The value in use is 31,500. So as they are both lower than the carrying amount, there would be an impairment on asset 2. Asset 3, we can also see that the fair value less cost to sell is lower and the value in use is lower. So it would be assets 2 and 3. What is the impairment amount to be included in the statement of profit or loss? So for asset 2, it would be the current value. So we've got 37,500 minus, and remember we want to pick the higher out of these two figures. So it would be now valued at 34,000. So your difference there is 3,500. So that would be your impairment for asset 2. For asset 3, it would be 75,000 minus, quite clearly, the value in use, because it is the higher out of the two. So 65,000, giving you 10,000. Add both impairment values together to give you a total impairment of 13,500. Covers off task 7. So now let's look at task 8. Identify which of the following best describes an intangible asset under IAS 38. An identifiable non-monetary asset without physical form, or an identifiable monetary asset with physical form. It's actually classed as a non-monetary asset. Okay, so such as software, goodwill, as I said, trademarks, even patents can be included as well. Patent, if you're American. They are classified as non-monetary assets, okay, without a physical form. So you see here, physical form would be a tangible asset. B then. Complete the following sentences and choose from the following options. Amortization is the same as blank. However, amortization only applies to intangible assets. Well, amortization is the intangible version, really, of depreciation. So it's the same as depreciation, but for intangible assets. However, amortization only applies to intangible assets. Intangible assets with A, and we've got to pick, so that would be a something used for life are subject to amortization. So what they say is that it's under a definite useful life, i.e. there's a measurable life to that asset. So often trademark, patents, stuff like that, they have a number of years that are attached to them before they expire. Intangible assets with something useful life are not subject to amortization. So that would be indefinite. But instead are reviewed annually for impairment. Identify which of the following are examples of intangible assets. So goodwill, definitely. Inventory, absolutely not, it's tangible. Development costs can be an intangible asset, but we'll look at those very shortly to see when they can and when they can't be. And then trademarks, licenses, and patents. Computer equipment and vehicles. So we've got, just go back to my pen. Vehicles, computer equipment, inventory are all tangible assets. Moving down to part D then, identify which of the following statements are true. So internally generated brands cannot be recognized as an intangible asset because they cannot be measured reliably. Well, that would be absolutely true. That is essentially a business coming up with their own valuation on their brand. Now, it is feasible to pay an external company to value your brand. How they do that can be very complicated, but it's stuff you've got to think about. Brand awareness has a value attached to it, which is why, just as a random example, if Cadbury's bring out a new chocolate bar, people will be more inclined to buy it because they know the brand than they would be, from someone that they've never heard of. So there is a value that can be measured by an external company, but it cannot be done internally. Okay, so intangible assets which meet the recognition criteria should never be shown in the statement of financial position. Well, that is definitely not true. If they meet the recognition criteria, then they can be valued as an asset within the statement of financial position. Intangible assets which meet the recognition criteria should be shown in the statement of financial position at their original cost. Okay, well, that is true. Certainly can be. Indefinite life intangible assets are not amortized, which we spoke about earlier. We know that that is true. Instead, they are reviewed for impairment, and if a finite life can be established, obviously, that could then change if that changes. But for now, that will be true. Intangible assets with an indefinite life must be amortized over that life on a systematic basis. Well, that isn't necessarily true, because for a start, we would look to impair them rather than amortize them. So that would be false. Right then, Swanson Supplies is a large company that spends a lot of money in research and development. So super important, this. Danica, a colleague, has emailed you asking for some advice. She has asked whether or not she should capitalize some recent research and development expenditure, and she's unsure of what the criteria is. write a short email to Danica and outline what the criteria is for development expenditure to be capitalised in accordance with IAS 38. So this is basically, how do we determine whether we can capitalise development or whether it would go as revenue expenditure to the statement of profit or loss? So the best way to remember this, and there is some memory involved, I'm not going to lie to you, there is some memory involved, is through Pirate. Okay, so we first, well, we'll just, as it's an email, let's make sure that we are doing it as an email. So good afternoon. So it is very important that we are, when we are doing these, we do it in the format that is asked for. So email, good afternoon, Danica. We would write off research and development to the statement profit or loss. However, if go back, however, if the development expenditure this is very important, meets, I would say, meets all of the following criteria. Just a bit ambitious there with my writing. Following criteria. Then it may be capitalised. Criteria is as follows. And I would remember this through what we know as Pirate. So literally, as you'd imagine, full on Jack Sparrow style pirate. So we have probable future revenue. I.e., it's not just testing. There is a likeliness that this will come to market. Economic benefit. I, intention to complete it. R, since it's pirate, R. Resources are available to complete it. I.e., we have the tools and we have the materials and we have the labour in order to be able to finish off the project. A, ability to use or sell it. T, technically, feasible to complete it. And then lastly, E, expenditure. That can be identified separately or can be reliably measured. Now for those, like I said, there is no sort of cheat method really with those. It is just remembering them. The best way that I can that can help really there is using Pirate to be able to remember each point. But it is a case of learning them. Very, very important to learn them because it could definitely come up in an exam this in a written style question. So just please do bear that in mind. Right then, just a couple of bits to finish up then. Last task 9, identify from the following what inventories must be valued at under IS2. I think we probably know this now. This would be the lower of cost and net realizable value, something that was covered in level 3 as well. Then identify from the following which costs should be included in the costed inventory. Well, you definitely can't include selling costs. That would be after the fact. Transportation costs to the warehouse, absolutely. So again, it's bringing the items to a usable condition. And we could also include import costs. However, we could not include storage and distribution. Part C, calculate the value of inventory to be stated as in the financial statements according to IAS2 inventories. So as we said, these inventory needs to be valued at the lower of cost, i.e. what it cost you, and the net realizable value, which is effectively what you can sell it for, less any costs to sell or repair costs to get it in a sellable condition. So I'm just going to put a great big X straight through LIFO because under IS2, they do not allow LIFO as an inventory valuation method. So it can be used within management accounts, but it can't be used for your financial statements at year end to be uploaded to Companies House. So we're looking between FIFO and the NRV, which is net realizable value, for the lowest figure. So it would be 25,000 for T100, 16,400 for Y300, and 35,800 for Z500. And all we would do, add the figures together. So 25,000, 16,400, and 35,800. Here is a total of 77,200. So that would be our inventory valuation. Last question then. The business sells the following 3 products, C3, F5, H6. In accordance with IS2 inventories, what is the value of closed inventory to be recognised in the financial statements? So NRV is your selling price less your selling costs. Okay, so what we would do is effectively look at the lower, the cost, and the NRV. Okay, so we have cost 27,000, and then our selling price less selling cost would be 30,000 minus 240. 30,240, sorry, minus 40,080, which is 26,160. Then on the next one, put 53,040 less 960. 52,080, and then on the last one, 42,240 minus 2,640 equals 39,600. So all we want to do is now pick out of the lower the fees and your cost. So on C3, it would be 26,160. F5 would be 51,840. And for H6, it would be 39,120. So all we would do, add the three together to get your valuation, which would be £117,120. Excellent. Right, so that covers off everything we need within this for this session. That covers off all tasks that we're going to go through for that particular chapter. If you've got any questions, obviously do put them in the Q&A box, and I'll pick those up. Okay, no worries. Well, that's absolutely fine. If anything comes to you after the session, obviously just ping me an email and I will get back to you as soon as possible. Well, thank you for attending. Enjoy the rest of your day. Thank you.